Hi, this is Krish from QI. We continue to see stress in the banking sector. Stocks remain volatile, with Europe marking new lows as concern shifts from Credit Suisse to Deutsche Bank. Now, the European banking sector is really important for that economy. It's the mainstay of funding. There was a foreign central bank tapping Fed swap lines for $50 billion last week. Identity is not known, but we think it might be the Swiss National Bank, given the big Swiss merger last weekend. Back in the US, deposits continue to lead the banking sector for money market funds. But stress levels for bank funding were overall somewhat calmer, with the sum of the Fed's discount window and the new BTFP program flat on the week. Also, the Fed hiked rates last week by 25 basis points and held its ground on the possibility of further hikes. But there's clear disbelief from the market, which is pricing lots more cuts, and US government yields have continued to drop. There's major economic concern over over-levered sectors, in particular commercial real estate. Going back to the banks, we need to be careful not conflating market price moves on their shares with genuine problems. Silicon Valley, Signature, and Credit Suisse had disastrous problems, losses on their books, bad risk control, deposit flights, and so on. But that's not the case for the whole banking sector. But unfortunately, the stock market seems to be testing the theory. Now, there was some confused messaging as well from the authorities last week around the backstops being provided for the banks, and they need to figure the messaging out quite quickly. The week has ended with Janet Yellen calling an emergency meeting of the Financial Stability Oversight Council on Friday, and that includes the Fed chairman. Now, this clearly spooked stocks on Friday, which fell hard into the end of the week, and it keeps the pot boiling for investors. We'll keep watching for you. Thanks.